Good morning and welcome to Capital Sound. If this rally is a peace dividend, why are bonds still pricing inflation risk? I am Mandy Prince, and with me today is Bernard Gray.
Good morning, Mandy.
Quick snapshot before we dive in. Equities are pushing higher this morning, while bonds are still acting cautious. Volatility is calm but not carefree, and the leadership looks tilted toward higher beta areas while defensives are a touch softer. Yields have nudged up again. Those are the numbers. The real question is what they actually mean. Bernard, let's start with your main read. Why does this peace rally feel so uneasy?
My thesis is simple. This move is not a regime shift. It is a squeeze. The mathematics and the behavior of the bond market do not validate a durable risk. On turn, it feels like a bear market squeeze wearing a peace rally costume. The market is celebrating headlines, but the underlying inflation impulse is still present. And bonds are refusing to bless a pivot.
That is a strong claim. Walk me through it like I am not glued to a Bloomberg terminal.
Think of it like this. The stock market is throwing a party because the fire alarm quieted down for a moment. But the smoke hasn't cleared in valuation terms. I look at what businesses can reliably earn across cycles. If inflation remains sticky, the discounting of those cash flows doesn't suddenly become friendlier. So the party is loud, but likely brief.
Okay, so for listeners, you are saying the good news was a headline, but the bond market is still warning us about inflation.
Precisely. The bond market is the sober adult in the room.
Let's sharpen the clash if this rally needs a validator. What is the one commodity that matters most to confirm it?
Oil. Without a clear and sustained drop in energy costs, inflation expectations don't actually relax. Consumers see gasoline prices every day. If those costs stay firm, the central bank stays boxed in.
Translate that for me. You are saying as long as people feel gasoline biting their wallets, policymakers can't declare victory and stocks can't celebrate for long.
Exactly. That is the human side of the math.
I want to push back a bit. We've had some cooling in labor data. Why isn't the long end of the bond market reacting more?
Because inflation persistence is the dominant variable right now. A softer jobs print is a start, but it doesn't eliminate the price pressure baked into essentials. In my experience, this is similar to the 2022 rate shock. The market tried to front run a pivot more than once, and each time, stubborn price pressure pulled it back.
That is a useful parallel. You are saying the bond market remembers the 2022 rate shock and won't move just because hiring is a touch softer.
Correct. Bonds respond to a sustained trend, not a single data point.
Let's do a hard split. Is this a headline squeeze or the beginning of a disinflationary risk on shift?
At the moment, it is a squeeze. The flow of money is moving faster than the fundamentals. I can't see an enduring turn without energy unwinding.
If I am a listener hearing that, I might think, okay, then what would change your mind?
I would change my mind if two conditions appeared together. First, a verified ceasefire that actually pushes oil down, not just intraday relief. Second, a meaningful deterioration in hiring that signals demand is cooling broadly. That combination would loosen the inflation narrative and support a more durable rebound.
That is the surprise. You and I are usually on opposite sides of the emotion curve, yet you are laying out a scenario where you could flip to risk on.
I am cautious, not immovable.
Now, let's talk rates. We've seen some softening in labor data, yet the long end is still skeptical. Is the bond market saying not so fast?
Yes, in mathematical terms, the long end is pricing a higher probability that inflation runs above comfort for longer. That caps duration demand. The rational investor sees the path of real purchasing power as the core risk. If that is uncertain, you don't bid long bonds aggressively.
So, in plain English, bond investors don't believe inflation is tamed, so they're not buying the long dated stuff the way they would in a genuine pivot.
That is an accurate translation.
What does that imply for equities?
It implies the equity rally is fragile. When the discount rate doesn't fall, the market can't re-rate the way it wants to. You can get a squeeze, but the valuation anchor remains heavy.
I want to interrogate the squeeze point. Is this really just short covering and releveraging?
It is largely flow-driven, yes. The last month saw a heavy risk reduction. When the headline tone improved, the fast money reversed course. The critical question is whether long-term capital follows. I don't see it yet.
That sounds like you are separating the fast money from patient money.
Exactly. The patient capital weighs cash flows. It doesn't chase headlines.
Let's pivot to the cryptocurrency pop. Some people see that as a pure risks on tell. Are you buying that?
I view it as froth, not confirmation. Crypto can surge in a reflexive move when liquidity and leverage return briefly. But if inflation pressures remain, that liquidity is not durable.
So you are saying it is not necessarily a vote of confidence. It might just be leverage chasing.
Yes. That is why I am cautious about reading too much into it.
This is where I want to be sure listeners follow. Crypto moving up doesn't always mean the economy is improving. It can mean people are taking more risk quickly, even if the fundamentals are shaky.
Precisely.
You use the term duration bid. Translate that for the everyday investor.
Duration is how sensitive a bond is to interest rate changes. A duration bid means investors are eager to buy longer term bonds because they expect rates to fall and inflation to cool. That is not happening with conviction.
So without that, risk assets don't have the wind at their back.
That is the implication.
Let's return to oil. You keep coming back to it as the validator. Why not wages or housing?
Wages and housing move more slowly. Oil is immediate and pervasive. It hits transport costs, supply chains, and consumer expectations in real time. It is the simplest signal. And in this moment, the market needs a simple signal.
I hear you, but listeners will ask if a ceasefire is verified and oil really drops. Do you become bullish?
I would become less defensive. Yes. I would see a credible path to cooling inflation. However, I'd still be selective. I prefer businesses with stable earnings and strong working capital.
That is your value first lens. You are not going to chase the noisiest rebound.
Never. Discipline in analysis protects against error.
There is the professor. Let's pressure test your skepticism. Suppose oil dips for a week and then rebounds. What happens?
Then I view the rally as a false start. I would expect equity enthusiasm to fade and bonds to remain guarded.
Here is a challenge. Some people argue the market has already priced a lot of pain, so any relief should last. Why aren't you on that side?
Because prices are only one part of the equation. If the fundamental earnings power of businesses doesn't improve under a lower inflation regime, then the valuation discount is still valid. I've seen this pattern before. In early 2020, a relief bounce preceded another drop because the fundamental damage wasn't resolved.
That is a strong historical reference. You are saying a short-term rally doesn't necessarily mean the storm has passed?
Exactly.
I want to make sure listeners understand your framework. You are using math, not emotion, but people might ask, how do I think like that without a spreadsheet?
The principle is straightforward. Ask, do the underlying business earnings look more predictable today than they did a month ago? If not, Be careful about treating a fast rally as a new foundation.
That is a helpful lens. It is about stability, not speed.
Indeed.
Let's talk about Japan. You flagged tightening risk there as a cross-current. Why does that matter to a U.S. investor?
Because global financial conditions are interconnected. If Japan is moving toward tighter policy, global liquidity can tighten at the margin. That makes it harder for risk assets worldwide to sustain a rally.
So in plain English, if Japan gets a bit tighter, the global money environment gets less friendly, which can take some oxygen out of risk assets.
Exactly.
I want to inject a bit of pushback. Some investors say these global policy differences are background noise compared to earnings. Are they wrong?
They're not wrong, but they're incomplete. Earnings matter most over time, but policy conditions can determine whether investors pay a premium or demand a discount for those earnings right now.
That is a nuanced point. The prices people pay for earnings can swing with policy, even if the earnings themselves are steady.
Correct.
Let's pause and recap where we are. You are calling this rally a squeeze, not a regime shift. You want oil to validate it. And bonds are refusing to bless a pivot, which keeps you cautious.
That captures it.
I am going to be a little skeptical here. If the bond market is so wise, why do equities sometimes lead and bonds catch up later?
That happens, and I respect it. But in those cases, you typically see a broad improvement in inflation trends. I am not seeing that in the most immediate consumer visible prices. So I am sticking with the bond market as the gatekeeper for now.
For listeners, that is the core tension. Stocks are celebrating, bonds are skeptical.
Precisely.
Let's bring in the vivid metaphor you used earlier. You said this rally is like a house party during a fire alarm that is strong. What does that mean in practice?
It means the celebration may be real, but it doesn't solve the underlying danger. In practice, it suggests investors should treat the move as tactical, not foundational.
I am going to translate that: enjoy the relief, but don't assume the risk has disappeared.
Exactly.
I'd like to do a quick scenario check, not because we're predicting, but because listeners like a framework. Give us two paths from here.
Fair. Scenario 1. If oil genuinely cools on a verified ceasefire and hiring softens materially, I expect bonds to finally relax and equities to find firmer footing. The signal to watch is whether long-term yields stop pushing higher, despite better news. Scenario 2. If oil stays firm and labor remains resilient, I would expect the rally to fade as bonds keep warning. The early warning sign is any renewed jump in inflation expectations.
That is clear. In plain language, if oil drops and hiring cools, the rally could stick. If not, this is likely a temporary burst.
Precisely.
Now, I am going to ask the uncomfortable question. If you are right, what is the biggest mistake investors might make this week?
Overreacting to a single headline and treating it as a green light. The rational investor should reduce the number of decisions they make when signals conflict.
That is practical guidance without telling anyone what to do.
It is about restraint.
Let's go back to crypto for a second. Some listeners might see it bouncing and think it means liquidity is back. You are saying it could be the opposite.
I am saying it could be a short-lived echo of leverage returning. If inflation remains sticky, that liquidity can be withdrawn quickly.
So it is a tell, but not necessarily a trustworthy one.
Exactly.
You mentioned the bond market being the bouncer. That is a vivid image.
The bond market is deciding who gets into the party. If it doesn't open the door, the rally doesn't get bigger.
That is a quote people will remember.
Good. It is a simple picture.
I'd like a quick personal moment. Have you been burned by a similar setup?
Yes. In 2020, I underestimated how far a relief rally could carry before fundamentals caught up. It reminded me that disciplined analysis should be paired with humility about short-term moves.
That honesty is useful for listeners. It is not a certainty game.
It is a process.
Let me challenge you on one more thing. You keep emphasizing inflation persistence, but what if the market is simply pricing a growth slowdown instead?
That is plausible. But a growth slowdown with inflation persistence is not a clean setup. It is a squeeze, not a pivot. That is why I am cautious. If growth slows enough to pull inflation down, I'll adjust.
That makes sense, and that adjustment requires evidence, not hope.
Precisely.
Before we close, I want to give listeners a clear summary in different words. This rally might be loud, but the foundation is still shaky because energy prices and bonds are not cooperating.
Well put.
Let's do the one takeaway moment. If listeners remember just one thing from this morning, what should it be?
A single headline cannot repair a macro regime. Wait for oil and bonds to confirm the story.
That is crisp. Now, the watch list, 3 items, and we'll keep it tight. First, oil, does it actually unwind or does it hold firm? Second, the bond market, do long-term yields soften meaningfully or stay stubborn? Third, Japan's policy tone, any hints of tighter policy that could keep global liquidity less friendly?
Those 3 will decide whether this is a trap or a regime shift.
Bernard, final thought before we go.
The market eventually weighs true value. It just doesn't always do it on our preferred schedule.
Thanks for listening to Capital Sound. Have a great trading day, and we'll be back this evening with a full recap of how the day played out. Have a steady morning, and goodbye.